Calling to order the Lake County Investment Advisory Committee, 16th day of July 2026 in Commissioners' Chambers at 9:45 a.m. We'll begin with a call to order. Mr. Secretary.
Yes, I'd like to have the roll call. Commissioner Plechnik?
Present.
Commissioner McIntosh?
Present.
Treasurer Zurin? Present.
Next, we have approval of the minutes for the meeting of April 16th, 2026. Do I have a motion to approve waiving reading of the same?
Move to approve.
Second.
Any discussion? Hearing none, all in favor say aye.
Aye.
Aye. Any opposed? Any abstentions? It is unanimous. On to old business. Any old business to come before the committee? Any old business? Hearing none, on to new business, beginning with investment review. Ms. Stanek.
Thank you so much. Really appreciate it. Definitely interesting day here today with the smoke smell, and we certainly hope that the wildfires in Canada are resolved so we can all breathe properly. But needless to say here, have a lot going on in the marketplace. Clearly remaining to be a time of heightened uncertainty and changing economic conditions to some degree. We know that the Fed had lowered rates significantly coming into 2026, and the expectations originally were that they would be in a position to continue to lower rates in 2026, but the Iran conflict and the resulting increase in inflation has put them in a hold stance at this point. That's compounded by the fact that we have a new Fed chairperson with Chairman Kevin Warsh. The market, though, now is anticipating that the Fed will next move will be to raise rates, perhaps one additional rate hike by the latter part of this year, maybe even two by the end of 26. So there's a lot of discussion about, is the market ahead of itself, or will conditions change? We know a lot will depend on the resolution of the Iran conflict and, of course, the flow of oil. And I know this morning there was just news that now there's talk of blocking the flow of oil coming out of the alternative routes to the Strait of Hormuz. And that, of course, has caused the price of oil to tick back up here today. Oil, of course, is flowing through to inflation. When we look at the inflation rate at last read, when this was printed, it was 4.2%. When we received an update Monday, inflation has dropped to 3.5%, but 1 month does not a trend make. We do know that because certainly if with oil moving back up, we could see uptick again in inflation. Economic growth has been pretty steady, with the first quarter economic growth at 2.1%. Expectations are for the second quarter to be a little bit stronger, and that overall economic growth for 2026 to be around the 2% level. Labor market has been uneven, to say the least, particularly when we look at the job creation, but when we look at the unemployment claims, that has been holding rather steady, indicating that companies are not necessarily letting people go. And then lastly, we have seen an uptick in rates, which has for us presented an opportunity from the investment side. I wanted to wrong button. Wanted to just touch on a couple points about Kevin Warsh coming in as Fed chair. Important part is that while he is bringing a new mindset, we believe, into the Fed, he is really only one person. This is a committee that does drive the course of monetary policy. One of the positive things so far that we have seen is that Chairman Warsh has formed 5 task force who will be looking at various items that will then help them, they believe, determine with more certainty the appropriate course of monetary policy. And those 5 task forces revolve around communications, the balance sheet policy. As we know, the Fed holds a tremendous amount of Treasury securities on their balance sheet versus allowing those securities to be traded in the market. The quality and timeliness of data. There's been a lot of discussion over the past year and a half about the the fact that much of the data is backward-looking versus monetary policy requires more of looking forward as far as how the economy is moving and how those data points would be moving. So clearly this is a very important piece. Also looking at productivity and jobs, the impact of AI. There's, of course, a lot of discussion about AI will displace workers versus the other side of the coin is, well, AI may not necessarily displace as many workers. It may just change the jobs that folks currently have. And so that will require maybe a different skill set. And then the last piece that a task force will be looking at is an inflation framework. So clearly, as we know, inflation of the past 3 years has been a big factor in monetary policy, and inflation has really when we had the first spike was primarily driven based off of the stimulus dollars that flooded the economy with monies, and then of course this inflation has been a result of the spike in oil prices due to supply disruptions to that oil. So a lot more to come from these task force. When Fed Chairman Warsh did his testimony to Congress yesterday and Tuesday, he did mention that the intent is to have the task force come to some conclusions or at least some recommendations within about a 6-month period. So a relatively quick turnaround, which is encouraging because the market gets impatient, to say the least. Any event, just moving along here, this is where the market is showing the expectations for the rate hikes versus rate cuts. We can definitely see that difference, that change in that path from when the Iran conflict started. This is the inflation number. Again, talking about the timeliness and the quality of the data. There are alternative inflation measures out there, one of which is this Truflation, which is a independent provider, so it's not a government agency. And what they're doing is they're scraping 35 million prices daily and using as sources places where, you and I and the normal person will shop, like Walmart, Amazon, and the like. And so getting actual read on those movements of those prices. And as we can see here, the Truflation number is significantly lower than even the drop that we recently had in the CPI at 3.5. And part of that is because it's more of a real-time view of inflation versus a historical look back. And so it'll be interesting to see if that will come into play. This is the growth, as we talked. This is the unevenness in the job market. It's interesting that the average labor job growth has been in that 111,000 range. And when we go back and look at historically since the 1970s, the average job growth in the times when the Fed does raise rates, when job growth has been around these levels, it's only at about 22% of the time over the past 50 plus years that the Fed has raised rates. Fed has generally not raised rates until we've seen job growth exceeding the 200,000 level. So again, I think this is another factor that the Fed will be looking at, is those labor market numbers. Talked about yields are high. We can see here the average 2-year yield, it has remained elevated. And again, we're rivaling those rates that we saw pre-housing crisis. And then this is just a very quick snapshot of the yield curve, comparing it from where it was at the coming into 2026 to where it was at the end of last week, and we can see the significant increase in rates where the market has priced in, of course, this world of perhaps some higher inflation, continuing solid economic growth, and of course uncertainty. So we know that the market does raise rates when we're in environments of uncertainty. And that is reflected here, and that is clearly presenting some investment opportunities for the county that we are capitalizing on. So the portfolio of the county, ending as of June 30th, cash $151 million. When we say cash, these are interest-bearing accounts that are available. Funds are available overnight. Securities portion of $268 million. We do want to keep in mind that starting probably in the fourth quarter of 26, some of the dollars that are in this $420 million total will start to be used to pay for the balance of the Safety Service Center. Those costs are estimated at about At last time we had met, about $80 million. So we will see the county's cash drop as a result of that. We are showing, of course, the engineers and the safety center project monies separate. Again, the safety center, safety service center dollars, though, that represents what's left of the bond proceeds or the note proceeds. Weighted average maturity, our average yield on the portfolio is 3.84. That's up from 3.77% at the end of the year. So clearly, as we have invested monies and take at higher rates, the lower yielding securities that had been purchased during different interest rate environments are coming off, has contributed to the increased yield.
And Ms. Stanek,
Yes.
yeah, I wanted to point out to the committee a few things that we've been working on. So one of the things is if you look at the 0 to 1 year bucket with the funds that are going to be maturing over the next year, it's a 3.64% return. If you break that down even further, if you just look in the next 90 days, the actual securities that are maturing is at a 3.56% rate. Right now, we have the opportunity with what is available in corporate bonds and commercial paper and the treasuries between the 2 and 3 year investment bucket, and also CDs and overnight investment. They're in the low 4% return rate. So there's probably, we calculated about 75 basis points of improvement on some of these maturing securities that are happening over the next 90 days. And with everything that Ms. Stanek went over, there should be opportunity for a while due to what's happening in the marketplace with Iran and inflation to improve on our return based on what's maturing over the next 12 months. So I just wanted to point that out, that we're in good position for the future for return. Also, I did look at the return for the year so far, since we're at the midway point, basically, and it does look like we will be close to $20 million in investment return on the county portfolio. And with it, I also just want to thank Ms. Stanek and Meter for all their knowledge and expertise in getting us into this position, which is very favorable for the county.
Yes, thank you. Only possible with the collaboration with the Treasurer's Office.
Thank you.
Thank you.
And I would only supplement that by saying we need to remember as a county that we benefit from the higher interest rates with respect to the cash and cash equivalents that we have invested. We also pay higher interest rates on the bonds and the notes for the jail and other debt that the county carries. So it's a double-edged sword. You know, sometimes it sounds like a bonanza on the one hand, and we need to kind of cool the jets a little, because even though the job that you're doing is excellent and it helps to offset the interest costs that we experience, but high interest rates are not necessarily good for the county. On the one hand, we get a higher return on investment for unused capital. On the other hand, we pay a higher interest rate on the very substantial debt we have. So it's all the more important to get that better return because we are paying higher interest rates as well.
Yes.
Yeah, I just want to say thank you. I appreciate these updates. They're very thorough, great, provide a lot of things to get in front of us. And I would just like to echo, I'd like to thank the treasurer. I know he does a really good job with his department. I appreciate your closing remarks there, Mr. Zern. And also to echo what Mr. Plechik said, this is a substantial enterprise that we operate here in the county, and debt is a part of it. Cost of debt is a part of it, and the ability to earn interest is also a part of the equation. And we know that we have the capital project. It's a very necessary one for the safety center, and we're proceeding with that with responsibility. We're paying some debt down, and we're doing it right. So it's always a balance between expense and cost and managing the ebb and flow of the economy. So I feel good about where we're at. Thank you.
Excellent.
Thank you.
Any further new business? Any further questions for Ms. Stanek? Hearing none, I would entertain a motion to adjourn.
Move to adjourn.
Second.
All in favor?
Aye.
Aye. Any opposed? Any abstentions? It's unanimous. The Investment Advisory Committee is adjourned at 9:59 a.m. The Commission